All right. Well, let's go ahead and get started. I know a couple other people are going to be jumping on, so they can just jump in the middle once we go. So, good morning, everyone. We are. Thank you for joining us for Coffee with Chris. We're here every Thursday morning at 10 a.m., taking 15 to 20 minutes to talk about something going on in the market or something that's come across our radar lately. Or sometimes we have requests from people to discuss topics. So anything and everything is fair game in the economy, mortgage world, real estate, all that good stuff. So this week's discussion is probably going to sound pretty basic, but it actually came up again to us this week. And it's a good reminder that for those of us who live and work in the mortgage and real estate industry, we breathe these things. And it's just a good reminder that we can't assume everyone knows, the things that we know. So that's why we're going over this topic. So we're just going to be talking about down payments and busting the myth. Do you need 20% to buy a down payment? Because that's what came to us this week. We had a client. Client was inquiring, concerned about how they were going to get the 20%. And we were like, whoa. We got lots of options. So, Chris, do you want to talk us through just a couple of alternatives that realtors can have like in their tool belt to tell clients if they have a client that's concerned about, I don't have 20%, or I don't know how I'm ever going to afford 20% down.
So just to kind of go into that story a little bit. Now, here was a client he already owned 2 properties. So he's been through the process before, probably put less than 20% down on some of these other properties. And he was deciding to he was upsizing. So he was going to a bigger house that he needed, or he wanted to go into a bigger house. And he thought because he had already owned the 2 other properties that he has to put more money down. So it's as simple as that. Like to us, as you alluded to, Mindy, to us in the industry, it's like, oh, you don't know that it's a new owner occ deal. But the reality is people buy a house or do something with a home, maybe 5 to 7 years, and they forget everything because they depend on us to do most of the work and guide them. So they're not really doing a lot of homework other than trying to get the best rate or find the best agent. So let's talk about some of the choices that are out there. The best thing is if you can put 20% down, you're going to avoid some costs that you won't have to have, especially if you're going to go conventional. If you're going to do a conventional loan, if you put 20% down, you avoid PMI, which could be a substantial amount of money, every year, whether it was $200 a month or more, that's $2,400 to, $4,800 plus a year that you could avoid paying. But I think the one thing to talk about with PMI is it's prorated. So anything, from the least amount that you can have to put down is 5%. Now there's there's one other program with Fannie and Freddie. They each have their own for kind of what you would consider a first-time home buyer program, but it's not necessarily, you don't necessarily have to be a first-time home buyer, but they have a program that you can put as low as 3% down. Now, with Fannie Mae, that program is called the Home Ready program. And when you do it with a Freddie Mac loan, which is another conventional mortgage, that 3%, there's also a income requirement. So this helps people that may not be, they may be lower to middle class, but they want to have an opportunity to own a house and have the least amount of money down. These programs are really sharp because the PMI payment is typically less than the regular traditional conventional loan because it gives the opportunity to these people that make less wages an opportunity of the American dream, which is home ownership. And also the rate is sometimes a little bit different. But I just want to share, I'm going to just use Bradenton because we're here. These are numbers that you can look up in whatever county that you're in. But the area median income, if we're looking at the Fannie Mae program with Home Ready, is $77,200. All right. So the household income can't exceed that to qualify for that program with Fannie and Freddie. But again, the point is that you would only have to put 3% down. So say you're a single single man or woman, you're a teacher and you're making 70 grand a year or 75,000 a year, this would be a great opportunity for you if you weren't going to use some of the other programs we'll talk about in a minute. Now that's 3% down. You're going to get a better rate. You're going to get also you're going to get a little bit of a deal on your PMI, and it's going to be a little bit more affordable for you. Now, if you're looking at, the strange thing is the Freddie program in the same county, their 100%, their home possible medium income is between, they're saying 72,320, and they go up to 90,000. So some of these programs, we would look at different programs to see who has the best program to fit, that fits for the person that's coming to us. So those are two programs, right? That we're talking about. That's the minimum percent down. Then the next one would be an FHA loan. FHA is only 3.5% down. So now you have an option of Fannie or Freddie conventional if your income is lower than the median income, right? And the county that you're in, you have the opportunity to do a conventional loan. And the advantages of doing a conventional loan versus FHA is that mortgage insurance premium, that PMI that you hear about, falls off at a point when you have enough equity into the home. So with an FHA loan, you will have that PMI for the life of the loan. However, 3.5% down, there's no restriction. You don't get beat up for your FICO score like you do on a conventional loan. So your rate will be considerably lower. And it's another opportunity for people that, have a little bit of a challenge credit, their income, they may not have the best credit scores or a very high income, and they don't want to put as much money down. FHA is an awesome loan. It's a good government loan, 3.5% down. It allows people to get into a house for less money. I think that, a lot of times people don't understand that you can walk into a home, you buy a $300,000 house, and you can go in as little as $9,000 or $10,500 to put down on a house. Now, if you're going to rent a house right now in some of these markets, you're looking at rents being around $2,500, $3,000, $3,500. And if you have to put first, last, and security down, and that's not a fixed payment either, right? You could be on a lease for a year, and then that next year they could go raise that rent up another 5, 10, or in some cases we've seen rent go up 30% in some of these markets here. So you have no stability with renting. So if you're looking to move.
Can I interject real quick? Yeah. So I think we've noticed recently that we've been seeing more people going for the FHA loans kind of this summer. I'm curious your thoughts, but my suspicions are that since there's less overbidding this summer, since there's a little bit more inventory, buyers have a little bit more options, less bidding. The people who have felt like they've been left behind the last 2 years, or felt like they could never qualify, or maybe they were hard to qualify, they're starting to get into the game now. So right. I just want to encourage you guys, if you see FHA loans coming your way, or if your buyers are getting approved with FHA, that's a good thing. That means that we're opening up to buyers that couldn't buy before. This is good for all of us. That's a great
point, Mindy, because you've seen a lot of people, a lot of sellers. It was a seller's market. Let's face it. And a lot of these sellers and sellers agents, if you're a seller's agent, I'm sorry, but this is the facts. You were discouraging government loans coming through your door. You wanted clean conventional loans, more money down. You had the leverage at that point. And we're seeing a turn in that market where now it's opening up to these clients that have, I've had some cases, and I don't want to go off on a soapbox, so we have limited time, but I've had clients that they could get approved for conventional. So say, for example, I have a client with a 680 score. They're approved for conventional, but since their score is under 740, their interest rate's going to be about 0.75% higher than it would be if they had that, awesome FICO score. And what happens in some cases, it's cheaper to go with a government loan, even with the PMI. So it just makes more sense for them financially. You're doing right by your client by having them go into that program only based on FICO scores. And it's a great loan program. For one, most people don't realize the government loans, they're a lot more lenient with debt to income. I mean, I'm not going to go up as high as it can go, but I've seen them go through at 55% for an FHA loan, where conventional, you're not going over 50. So they're a lot more lenient in getting things approved, where I know the misconception out there is that they're harder. They're really not. The same appraiser that does your conventional loan is doing your FHA loan. So they're not like certain different appraisers that are doing these appraisals. It's the same appraisals. And I find down here, at least in this Florida market, I know I have other agents watching throughout the country, but in Florida, a lot of the agents that moved from somewhere in the Northeast remember that in the Northeast, these houses are 100 and something years old. And government loans, yeah, they're a little bit tighter as far as handrails going up and down stairs and chip paint on walls or outside walls, where you see a lot of houses painted up in the Northeast or Midwest. So when you're looking at things like that down in Florida, you don't find those problems as much. I don't run into those same issues. So keep in mind, guys, please, if you see that buyer come across your table with a pre-approval on an FHA loan, that's a solid deal. But let's keep moving. So we got 12 past, and I probably got about 5 minutes. And I got a couple other loan programs I want to talk about to debunk this 20% or 10%, 15% down. We also have 100% options, right? And you have your VA loans. I believe, this is my 25 years of doing this, the VA loan is the best loan on the market. One, we're supporting our veterans, and the VA does everything they can to get these loans approved. I've seen debt to incomes go out as high as 60%. And I'm not saying, oh yeah, they have 60% debt to income. That's a good thing, putting these clients in over their head, so to speak. A lot of times what happens with these VA loans is they're buying with a girlfriend or boyfriend or fiance, and that other person cannot go on that loan. So there is other income coming into the house that we can't use because they're not married. So we take all of that into consideration, but it does help when you can go stretch that out a little bit more for those borrowers that do have those situations where they do have more income coming to the house that we can't use. The next loan that we'd like to talk about is USDA. Now, when I was in the Northeast, I still do a lot of these loans in the Northeast. There's a lot of areas that qualify for that loan, but that next to the VA loan, probably a close second or tie for first, is an awesome program. And I know a lot of people that could attest to this program, because it doesn't mean you don't have money, right? If you can qualify for this VA loan, your rate's going to be better. You might be able to put the money down, but if you qualify and your income is under a certain amount, this is the best. This loan is fantastic. I think here in the Manatee and Sarasota County, I think the income requirement is under 87,000 and change.
I think it's 88,000 sounds right. Something like that.
88. Yeah. So 88,000, you make less than that, but you have to be. So this is my area. You can go to the USDA website and you can punch in an address and see if that address qualifies for the loan. Mm-hmm. If you're here in Southwest Florida, where we are, if you're east of 75, you're going to qualify for that loan in Bradenton, Manatee County or Sarasota County. Most properties that are east of 75 will qualify for that. And that's a fantastic program. It's 100%. We also have another program, which it's the FHA loan. However, there's a grant that's tied through the Shanoa Fund. And Shanoa allows somebody to get 100% financing. In some cases, that 3.5% is forgiven. Now, I don't encourage that loan for people that do have the money to put down, because the rate is a little bit higher, because there's a little bit more risk. But that 3.5% can sometimes be forgiven if payments are made on time for a certain period of time. So these are to kind of trunk out the four or five things that we talked about. You have two conventional loans with Fannie and Freddie that you can put as little as 3% down. Okay. Income requirements are in there that you need to be under a certain threshold. Now, if you go to the next step on the conventional side, it's 5% down. And you'll have PMI until you get to that point where you have 78%, loan to value into that property, and then that will fall off automatically. And I think there's a year in there. I don't have this right in front of me. It's like 8 or 9 years that will fall off. And you can actually pay to have an appraisal done through your servicer. And if it's at that point, they'll take it off a lot sooner. So if you see the appreciation in your property over the next 2-3 years, like a lot of people who bought 2 years ago, were able to go back to the lender or their servicer, pay for this appraisal, and then get this PMI drop. They don't want to charge it for you. It's just an insurance for them that ensures that if you defaulted on your mortgage, they'll cover that 20%. But if the equity's there, it will be fine.
So I think that what our realtors need to know is if you have potential buyers, friends, family, or buyers that are, feeling discouraged, what we want you guys to be equipped with is to tell them there are other options. Again, we don't want to ever assume that people know things. So I'll say this: we don't charge for a mortgage consultation. So if you have a buyer that's questioning, they can always call us and we can talk with them and give them kind of an idea of how things look. And you never know, that could just be the little bit of education that they need to move forward. So Chris, thank you so much. This was very helpful. Again, just a reminder for us never to assume that other people are in on what we're in on.
We know what assuming stands for, I think most of you, so I don't need to tell you.
I just wanted to say real quick, next week, we're going to give a market update, market and economy update. I was sitting waiting this morning because there's some major reports that are supposed to be released and they haven't yet. I was hoping I would have them by this, but I know that the jobs report's going to be coming out. There's going to be a report on inflation and a couple other things in there. We're going to aggregate all of that and give you next week the picture of what that's looking like in our area. Again, we like to cut through the noise and cut through the headlines of what everyone says and give a real picture. So we'll probably spend maybe 5 minutes giving you an update on that in addition to whatever topic we'll talk about next week. If you have a topic request, if you have a burning question, send them on over to me and we'll get it on our agenda.
Sounds great. And I appreciate all you guys that are watching. Please feel free if you have any questions outside of this, give me a call, message me, find me on Facebook, Instagram, LinkedIn. I'm on TikTok. I'm on it all. So you can find me easily under Chris Galley. So love to connect with you all. Thanks for joining and excited to hear from you sooner or see you next week.
Awesome. Have a good Thursday, everyone. Bye-bye.